We are back with Phil Davis, and it's time now for the 2026 Trade of the Year. Drum roll, please. Here we go. Phil, what is it?
It is Pfizer. And I know that's a big surprise to people who've been watching the news today because they just lowered their guidance.
Yeah, I was going to say interesting. Okay, explain why then.
Well, I mean, frankly, lowering their guidance was really what made us this morning say, oh, then we're going to go with Pfizer, because it put a nice floor on them where we say, okay, $25 seems to be holding up. And we think that's ridiculously undervalued. Even with their lowered guidance, they're still trading below 10 times forward earnings. They've got a fantastic pipeline. The thing about Pfizer is they made all this bonus money during COVID, right? They had the COVID vaccine with Moderna. It was the most popular one. They made 20 billion, 30 billion bonus dollars in profit. In a 2-year period, but it really quickly ran down from 20 to 10 to 5, and now it's like 2. And next year they're like, I don't think we're going to make any money on COVID. And of course part of that is the Kennedy stuff. What's going on.
Yeah.
But that's. It was bonus money, and people forget that this isn't money they were supposed to keep making. There was a disease, they eradicated it. They didn't eradicate it, but they knocked it down tremendously, and got it under control. So meanwhile, they gained a lot of cash, they paid down a lot of debt, they're in phenomenal shape for cash flow. And what they're doing now in today's announcement is they're basically kitchen sinking the thing and saying, okay, we're writing all this off. We're not going to have this profit next year. But now we're going to get back to business. Now we're going to just worry about our pipeline and do our developments and purchase other struggling pharma companies. So again, from the standpoint of steadiness, of sureness, of knowing that it's not going to go lower, is why we like Pfizer. We don't need a stock to go up a lot to make money on it, because the options take care of that. We just need to know it's not going down. And Pfizer nails that criteria for us.
You've got some notes you sent my producer. You said we just need to go from hated to tolerated, which I think is great. So listen, I've got 90 seconds, Phil. I want to get to the trade because it's important to people to see. So let's bring it up and tell us what you're doing.
Correct. This is another multi-leg trade, so they can check this out on the website if anybody misses anything, or they can hit pause, frankly. That makes it easy. It's another imbalanced long. So you see what the trick is the 2028s are imbalanced. There's 10 open slots. We sell the puts. Again, we're going to go back to that concept. If we sell the puts, we're promising to own it. Who doesn't want to own Pfizer at $25? It pays a 7% dividend. So please sell me the Pfizer. I don't mind. Then we're selling, now notice that quarterly, we're selling 3,100 in calls, and we're selling 2,400 in puts. That's $5,500 per quarter. And we're starting out with a $3,390 credit. So this is a credit of cash when you get it. You are promising to buy 4,500 shares of Pfizer for $25 each. So say $100,000 worth of Pfizer is what you're promising. But again, are you risking $100,000? Is Pfizer going to go bankrupt in the next 2 years? Highly doubtful. Maybe you're risking 5 times 45, which is $25,000, $30,000. Maybe that's your risk. So you got to be realistic about what your risk is. But your upside potential is $38,000, which is a 1,000% return on your cash outlay. I mean, that's incredible. Plus, you're going to generate an income off of the short put and call sales.
And the risk, sorry, I've got like 5 seconds, Phil. The risk is actually the purchase of the stock. You have to want to own it.
The risk is you own Pfizer, one of the most solid dividend-paying stocks in the history of the markets.